Hello, I'm Mr. Burton and I'm going to be going through market failure. In particular, we're going through unstable commodity markets and government intervention, i.e. buffer stock schemes. This comes under the Edexcel AS Unit 1 and it is an area that you have identified as being slightly tricky, so that's why I want to go through it today. So, commodity markets. What are commodity markets? So we have three which we will identify today. We have oil, we have wheat, and the third one is we have metals, such as gold. Now, commodity markets are a lot more volatile than normal markets because these are markets where consumers have much more reliance on these markets. We rely on oil for our everyday needs, we rely on wheat and food for our everyday needs, whereas normal markets, such as going and buying a car, the changes in prices and quantity of cars, for example, may not affect us as much as commodities. And this is why governments will try and maybe intervene in these markets to stop the volatility in prices and quantity. So, how do we characterise commodity markets versus normal markets? Let's assume then that this commodity market is looking at wheat. And let's say this normal market is looking at jumpers. So commodities, we rely on them and they're essential for consumers because we need to eat wheat, we need to survive. Similarly, if it was oil, we need oil to get to work. And therefore, the demand, you could say, for a commodity, for example, wheat, would be quite inelastic for consumers. So what do I mean by that? Inelastic demand, if you remember, means that if there was an increase in price of wheat, would I go out and still buy it? I probably would, yes. So that means that maybe a large increase in the price of wheat would only cause a small decrease in the quantity demanded. So therefore, commodities, in general, we can assume that the demand is inelastic. And we draw that with quite a steep demand curve, like this. So commodity markets are inelastic in demand, and so it is a steep demand curve. So how do they differ then from a normal market, the markets we usually look at in economics? Well, if there was an increase in the price of jumpers, let's say, you might assume that people would say, well, okay, there's an increase in the price of jumpers, I might just go and buy a jacket. There's quite obvious substitutes in normal markets, and if there was a large increase in price of goods in the normal market, then we would probably stop purchasing those goods. So the demand curve, therefore, is relatively elastic, like this. So within this unit, we're looking at the commodity markets, and as you can see, the difference between those are quite an inelastic demand curve compared to an elastic demand curve as seen with normal markets. So why does this matter then? Okay, so we start with a price here. In both markets, we start with the equilibrium price, where demand equals supply. So how do changes in quantity change the price in both of these markets? So let's say there was a large decrease in the quantity supplied in both markets. Let's see what the difference might be. So let's say wheat, there was a bad harvest, the weather was terrible, and supply of wheat decreased a lot. So it shifted from supply here to supply 1. And let's similarly say there was a completely same decrease in the supply of jumpers, like so, to S1 again. So here we can see there's a similar shift in supply, but what will happen with the the change in price then in these markets. So as you can see, with an inelastic demand curve, the quantity that changed was marginally small compared to quite a large increase in price. So in commodity markets, when the supply changes, when the quantity changes a small amount, the price changes by quite a large amount here. So there's been a shift to the left of quantity, there's been a decrease in quantity and a much larger, therefore, increase in price because of the inelastic demand curve that we see here. Whereas in a normal market, we see a similar change in quantity, Q1. But as you can see, a lot smaller is the price change. So as you can see here on the graphs, in the two different markets, we see here, shaded in blue, we have the change in quantity. There's been a decrease in quantity in both markets. A fairly similar decrease in both markets. But as you can see, the price increase has changed a lot in the commodity market. Whereas the price increase in the normal market has changed only a small amount. So we have shown that in a commodity market, a change in quantity causes a much larger change in price. In a normal market, a change in quantity causes a relatively smaller change in price. Now, as I've already said, consumers rely on commodities to live and to work. With oil, they need to get to work. With wheat, they need to eat. And so this large change in price can cause quite a lot of issues for consumers and for producers. Consumers need to be able to budget every day, every month, and every year. So the changes in prices, the huge volatility in prices here, can cause a massive problem with consumers budgeting. And similarly, it can cause a massive problem for producers who need to say, right, we need to invest in our company, but we don't know, for example, if we're going to have a bad harvest because we're producing wheat, so we may not invest in our company. So that's a second problem. Producers might not invest in the company because they're not sure what's going to happen because of the price volatility, and consumers may not budget either. These two issues are a form of market failure. So in the classroom, the way we looked at unstable commodity markets and government buffer stock schemes is we looked at it using a straight line like this. So if you remember, there was the planned supply and the actual supply. So this is what we're going to be looking at now. However, for your exams, you won't need to know the straight supply line. So I'm going to stick to showing you this just using a normal shift in supply line. And that's okay to put in your exams and you will get the marks for that. So first off, let's look at a good harvest. Now, hopefully you remember that a good harvest is when the farmer gets lots of his wheat in, and that means the supply and the quantity will shift a lot to the right. So we have a good harvest. That's fantastic. We've got supply was planned to be here, but actually the harvest was much better than expected. So supply is actually shifted out to the right. Supply one. So what we see as a farmer and as a market for wheat, a good harvest has meant that the quantity that the farmer has got has increased by this amount here. However, what has happened to the price of wheat from a good harvest? The price, as you can see here, has decreased quite a lot, as we've just discussed in the last graphs we were looking at. So we have a large decrease in price to a relatively small increase in quantity from the good harvest. This causes a problem for producers. It's fine for consumers. The price has dropped, that's great. We can get our goods for cheaper. However, this much larger decrease in price has meant that producers can go out of business. They only sell a few more units, but actually the price they have to charge for those units has dropped quite a lot. So this is bad for producers. So as you can see here, a good harvest where they produce more than they thought, more than they planned, supply shifted out, causes a relatively large decrease in price because demand is inelastic, and therefore revenue falls a lot more than expected, and producers of wheat in the commodity market here may go out of business, and that can cause market failure. So this is not a good situation to be in. So now let's look at a bad harvest. Now a bad harvest, again looking at wheat for example, means that we have a planned supply here. The producer thinks, right, this is how much we're going to supply, this is how much we're going to get from our wheat harvest, but actually it's been a pretty poor harvest and we haven't got as much as we thought we were going to get. The weather's been terrible and it hasn't gone to plan. So supply is actually shifted to the left. There's less quantity than we thought there was going to be originally. So what will that do then to the price of that commodity? Well, firstly, we show the quantity change, Q1. As you can see, the quantity has shifted to the left. There's less quantity than we thought there was going to be in the market, and price has therefore risen relatively by a large amount. So we have less quantity which is being produced than we originally thought, and that causes the price to go up by quite a large amount. As you can see here, and if you do this yourself, you will see that because demand is inelastic, that means that a small change in quantity, a small decrease in quantity, causes a large increase in the price, and that can cause a problem for an economy and for consumers. Because if we suddenly have to spend a lot more of our money on wheat, on food, on oil, that means we're not going to be able to understand what to budget on, and we're going to have a lot less money in our pockets. And that is another problem why commodity prices and commodity markets can cause market failure. In this example, consumers have to spend a lot more of their money on the commodity, and therefore they cannot budget. And that is another form of market failure. So we have seen on the previous few graphs why commodity markets, unstable commodity markets, cause a problem for both consumers, producers, and therefore cause a market failure. And that is why we study this when we're looking at market failures. So now we need to look at what governments can do to step in to reduce these market failures. So let's have a look at this graph here. It's a commodities graph again. It's similar to the other graphs we've looked at. Demand is inelastic because we're in a commodities market. And this is the supply that the producer has planned for the year. So what governments will do then, they will say, right, well, if prices go too high, that's bad for consumers because they'll have to spend more money than they originally budgeted for. And if prices go too low, then that will mean producers have had a price that is a lot lower than they originally thought. And so it's going to cause another market failure. So too high is bad for everybody and too low is also bad for everybody. So the government will intervene and using a buffer stock scheme. So they will say, right, well, this is the maximum price that we are happy for the price to go to. And this is the minimum price that we are happy for it to go to. So again, let's call this wheat. We have a price here. The government says any more than that, that's bad. Any less than that, that is also bad as a whole. So then, let's go back to looking at a good or bad harvest. Let's say it's a good harvest. Let's say there's a lot more produced than we originally planned for. So we are going to here. So this is the actual supply that's happened. And what we can recognise here is supply is shifted out to the right due to a good harvest. However, this has meant that the price has fallen below the price set by the government. The government say, no, this is not good for society. Producers are much worse off than we thought they were going to be. That means they are going to fail and it's going to cause a problem in the economy. So what do the government do then? They have seen that the price has fallen below the minimum price they're happy with. So the government will say, okay, what we will do is we will step into this market as the government and we will intervene. Remember, we're looking at government intervention to reduce the unstable commodity market problem. So the government will step in and say, right, okay, well, this is the price we're happy with here, and this is the price we're at the moment. So we will buy the goods up to this point. So we will buy all the supply from here to where supply hits the minimum price. So let's start again from the beginning. We plan for this supply, and the government has said we don't want it to go any further below the minimum price. But we've had a great harvest, lots of being produced, supply shifts out to the right more than we are happy with, because the supply shift has caused a price decrease so far below what we're happy with as a minimum price. So the government says, right, let's step in and let's buy all of the leftover stock to then shift the quantity back up, S2, back up to the minimum price level, and then we are happy that that's the price that it's going to be at in the end. And that's how governments can step in to sort out the problem of market failure by buying up the stock, and they will keep that stock and they will call it the buffer stock. So we've seen what can happen if there is a large increase in supply due to a good harvest. The government will buy up the extra stock needed to put the price back up to where it needs to be. So what happens then if there's a bad harvest and supply decreases a lot more than we want it to be as an economy? So let's use this example then. Supply here is again planned, and the price is here, quantity is here. This is way within what the government says is happy in terms of the price. However, we have a bad harvest and supply shifts all the way over here. So supply was here before, that's what we planned it to be, but actually a bad harvest shifted supply to the left. We had a large decrease in quantity, actually. So the quantity decrease was actually quite large in this one, but as you can see here, the price increase was huge. So the quantity decrease was quite large, as you can see, but the price increase because of that was massive. Look at that, huge. So what's happened here is the price has increased more than the government is happy with, more than the maximum price. So what does the government do? Well, we assume that the government has buffer stock. So we assume the government has enough wheat already held in their reserves to be able to sell that stock. So the government then will use their buffer stock of wheat and they will sell and put that onto the market. So they will shift quantity back out to where they want it to be. So they'll say, right, price is too high, quantity is too low, let's shift supply by selling our reserves to where we hit here. So what the government has done then is they have increased quantity back out to this level, just enough to get the price back down to the level we're happy with. So now the price is here at the maximum price the government is happy with. If it went up any more again due to decreases in quantity, they would again shift the supply outwards by selling their reserves. So what we have seen is how the government can intervene in commodity markets by setting a maximum price and a minimum price. And we've seen how the shift in supply is fine if you keep it within the boundaries. So if supply shifts out a little bit to here, that's okay. It's within the price, minimum price. If supply shifts left, that's okay as long as it stays within the margins. So as long as the price sticks within here, this is the price levels that the government is happy with. It won't cause too much issues to either consumer budgets or producer investment. But if the price drops any further below the minimum price or any above the maximum price, that's when we start to have a problem in the economy. And that's when we say as a government, anything out of these levels will cause market failure. And that's why the government will intervene in unstable commodity markets by using the buffer stock schemes. So what we have seen is why commodity markets are so important to the economy, and also why the government therefore will want to intervene in these markets to stop market failure happening. And that's the whole point of this unit, is looking at market failures and how governments can intervene. So we've seen what governments can do, and it all looks great. You know, the government can step in and solve the issue. However, that's not always the case. We have advantages of this and we have disadvantages of this. So the clear advantage of this is that the government can help to reduce uncertainty in the market. So the government can say to consumers, look, we're looking after the prices here and we're not letting them go above or below these levels. So consumers can therefore say, right, well, we're happy that we can budget within a certain amount. So the certainty to consumers goes up, which is great for the market. That market failure therefore might be reduced. Similarly, producers say, great, if the price goes too low, we know the government is going to buy that stock to cause the price to go back up. Producers love it. That means they have more certainty as well. So overall, it increases certainty in the market and stops unstable commodity markets from happening and brings about more stability. That's a major advantage of using buffer stock schemes and government intervention. There are disadvantages also to using this. What happens, for example, if the government saw that there was bad harvests consecutively? The government in the first bad harvest might have enough buffer stock to put back into the market. But if there was 10 years of bad harvests, that means that the government might not have enough buffer stock to ensure that that market is stabilised. So there are limitations to this scheme. It can only go on for a certain time if there's bad harvests all the way through. At the same time, if there is a series of really good harvests that push the price too low, the government has agreed they will buy up the stock. Therefore, we can ask the question, how much stock are you going to buy as a government if we keep having too much stock in the market? The government cannot keep buying and buying and buying this stock and storing it somewhere, because the costs of buying this stock every year, if there was 10 years of good harvests, consumers and governments might say, well, this is costing too much to do. So it can have financial implications due to the cost as well. And finally, probably the most obvious one with wheat or food as an example is the storage issue. So the government can buy up the food, the wheat, and have a buffer stock, but how do they store that without it going off or perishing? They might be able to for a few months and hope that they can sell it back on, but if they have to keep this stock for a while, then this stock might perish over time. Therefore, another huge implication for this scheme is the problems of storing the goods and them going off over time. And that is advantages and disadvantages of using the buffer stock scheme to intervene in unstable commodity markets.